Imagine being able to assess a company's financial health with just one glance. The balance sheet serves as the business world's ultimate health report. It's a powerful tool that provides a clear snapshot of how a company manages its resources, balances its obligations, and sustains its operations. Welcome to our channel. In today's video, we're diving into the topic of the balance sheet. Here's what we'll cover. What is a balance sheet? Key components of a balance sheet. Benefits of preparing a balance sheet. Limitations of a balance sheet. What is a balance sheet? A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It details the company's assets, liabilities, and shareholders' equity, showing how these elements balance out according to the fundamental accounting equation. Assets equals liabilities plus shareholders' equity. Components of a balance sheet. The balance sheet has three components: assets, liabilities, equity. Assets, resources owned by the company that are expected to bring future economic benefits. Assets are usually classified into current assets and non-current assets. Current assets, cash and other assets that are expected to be converted into cash or used up within 1 year. Examples include cash, debtors, and stock. Non-current assets, fixed assets. Think of these as long-term investments that a company uses to operate and grow over time. Fixed assets include property, machinery, and equipment that don't quickly turn into cash, but help generate revenue. Intangible assets. Unlike physical assets, intangible assets are non-physical and include things like patents, trademarks, copyright, goodwill, and industrial designs. Though you can't touch them, they add significant value to a business by protecting unique products or processes. Liabilities. Obligations the company owes to external parties that are expected to be settled in the future. Liabilities are classified into current liabilities, debts and obligations that are due within 1 year. Examples include creditors, short-term loans, and bank overdraft. Non-current liabilities, long-term debts and obligations that are due after 1 year. Examples include long-term loans, debentures, bonds payable, and deferred tax liabilities. Shareholders' equity, owner's equity. It represents the ownership interest of the shareholders. Components of shareholders' equity include share capital and retained earnings. Students, pause the video and take a moment to answer this question. Using an organization of your choice, list its non-current assets, current assets, and current liabilities. Now let us understand benefits of preparing a balance sheet. 1. Provides a snapshot of financial health. The balance sheet gives a clear picture of a company's financial position at a specific point in time. By showing what the business owns, assets, and owes, liabilities, it allows stakeholders to assess the company's stability and solvency. 2. Helps in decision-making. Managers use the balance sheet to make informed decisions about resource allocation, investments, and financing. For example, they can identify whether the company has enough liquidity to meet short-term obligations or needs to raise funds. 3. Evaluates liquidity and solvency. Key metrics like the current ratio and quick ratio are derived from the balance sheet. These ratios help determine whether the business can meet short-term and long-term liabilities, ensuring it can operate smoothly. 4. Facilitates financial planning. By analyzing trends in assets, liabilities, and equity over time, businesses can plan for future growth, identify funding needs, and strategize for debt repayment. 5. Builds stakeholder confidence. A well-prepared balance sheet demonstrates financial transparency, which is crucial for gaining the trust of investors, creditors, and other stakeholders. It shows that the company is effectively managing its resources and financial commitments. However, there are limitations as well. 1. Static nature. A balance sheet reflects a company's financial position at a single point in time, making it a snapshot rather than a dynamic picture. Financial conditions can change quickly, and the balance sheet may not provide up-to-date information for real-time decision-making. 2. Relies on historical costs. Many assets on the balance sheet, like property and equipment, are recorded at their original purchase price, historical cost, not their current market value. This can result in outdated valuations, especially for long-held assets, which may not reflect their true worth. In summary, the balance sheet is a vital financial statement that provides essential insights into a company's financial health, aiding stakeholders in making informed decisions and ensuring effective financial management. If you enjoyed this video, don't forget to share it and subscribe to our channel for more engaging content on business management topics.